Okay, good morning, everyone. Let's get going because it's a relatively lengthy presentation about the new proposed tax rules for corporations. And you all need to get back to work sooner than later because you need to make money, because you'll see that you're going to have less money going forward. My name is Denis Chenet. I'm one of the partners at Logan Katz Chartered Professional Accountants, and I'd like to thank you and congratulate you for being here this morning. It's exciting and comforting to see that so many of you recognize the significance of what was announced on a proposal basis on July 18th. Hopefully when you leave today, you'll have a good understanding of the facts that are behind these proposed tax changes. I don't know about you, but at our office, we've been flooded with countless articles and publications and opinions on what has been announced, and in particular in the media, there's a lot of information circulating that isn't factual or that's slightly incorrect. There was an editorial in the Citizen yesterday that contained factually incorrect information, and there's another one this morning written by a prominent columnist that refers to these new tax rules as being very minor. You can be the judge of that in about an hour and a half. And then it also goes on to contain slightly incorrect information as well. And so the purpose of this session is that when you leave, you'll have a good understanding as business owners, as advisors, and as citizens, and that you understand the implications of these on your businesses, but also on our economy, and we can all be the judges of that going forward. Just a few things as well before we begin. You've noticed that we have camera people, so the session is being filmed. It was such a popular event that not only did we have to expand the room, but there are people that we had to turn away. And so we will be providing the filmed presentation to people who were unfortunately unable to attend. And so I am going to be speaking for about 5 minutes before I pass over the microphone to Gary and Harold. And the purpose of my little segment is not to make you more mad, but it's to provide a little bit of context on various changes from tax legislation or in the economy that have already affected small businesses or that are on the cusp of affecting small businesses in the near future. And these changes combined to the ones that are being proposed, in my view, are considerable and will have implications either on your business, but as well in our economy. So I'm just going to do a quick walkthrough, 5, 6, 7 minutes. I will not go into anything in detail, but again, it's to provide you with a little refresher on things that would affect you in your businesses. And so the first element in the 2016 budget, you will all recall that anyone who earns in excess of $320,000 is now subject to a new marginal tax rate that went up at the time by 4%, and that rate is 53.5%. And on the corporate side, in the 2016 budget, and this is an item that sort of flew under the radar, but in terms of the government's intent to address the taxation of corporations, in particular professional corporations, there were significant measures already introduced in the 2016 budget that are in effect right now in 2017. And that is, whereas prior to that budget, you could set up groups, in particular within professional partnerships, where you could multiply the small business deduction, which is a threshold under which corporations are taxed at 15%. That is now essentially gone for these corporate groups within partnerships, which means that if you have 5 partners in a partnership, a legal partnership or medical partnership, who each had the ability of paying taxes at 15%, they now have to share that $500,000 threshold. So most of them are subject to a 26.5% tax rate for 2017. So the federal government is collecting significantly increased tax dollars as we speak. The Canada Pension Plan expansion, that was announced in June of 2016. And the quick observation on this one is that in 2023, if you have employees who earn about $80,000, The employer portion of the Canada Pension Plan contributions will almost double from the current amount of $2,500 to about $4,500. That will have a significant impact on your current staff and on your decisions of hiring new employees. You all know about this one. In May of this year, the Ontario government announced minimum wage increases that are such that in just over a year, the minimum wage will go up by 30%. That, again, will affect a lot of businesses, and we've noted in particular retail and hospitality, but also in other sectors as well. What a lot of people forget when they talk about the minimum wage increase of 30% is the impact on CPP, EI, and employer health tax. All those employer taxes are going up at the same rate as the minimum wage is going up. This was in the 2015 budget. This is another corporate measure. Very briefly, if you have an operating company where the shareholder structure was a holding company owning 20% of the shares and an individual owning 80% of the shares in a good share class organization, you could, if you had $100,000 of retained earnings, move it all up to your holding company, either for creditor proofing or perhaps to acquire a building or to invest. This new measure means that if the corporation, the holding company owns 20% and the individual owns 80%, and you have $100,000 of retained earnings, you can only move $20,000 to the holding company. You have to keep $80,000 for the individual. So there's now a matching of who owns what between corporate entities and individuals. It's got significant implications on tax planning if you're contemplating a sale or if you want to invest funds in a holding company. We hear the government consistently and constantly saying that the key to a healthy economy is innovation and investment in information technology. And so in order to encourage business people to do that, in 2012 they reduced the incentive for the investment tax credits for SHRED from 20% to 15%. They removed the ability to claim tax credits on any capital asset investments. They removed the overhead calculation, which we call proxy, from 65% to 55%. And they removed the ability to claim to include costs that you pay to third-party contractors from 100% of your cost to 80%. And then the Ontario people in 2016 decided those were great ideas and reduced the Ontario Innovation Tax Credit from 10% to 8%, and the Ontario Research and Development Tax Credit from 4.5% to 3.5%, potentially leading to reduced incentives to invest in innovation. We also hear our government say that it's important to invest in youth and in job training. So to reward employers for doing that, they reduced the apprenticeship tax credit from $10,000 to $5,000 in 2015, and reduce the period for which you can claim those costs from 4 years to 3 years. The interest rate that you're paying on your financing, this is not a government decision, this is a monetary policy decision, but nonetheless it affects all businesses and small businesses. So if you're running a line of credit, as of yesterday, your cost to borrow, even if interest rates are understandably very low, they've doubled. 4 months ago they were at 0.5%, and today it's at 1%. That's the prime rate from the Bank of Canada. The impact on lending rates can be more significant than that. We're also going through a NAFTA renegotiation. You all are aware of that as you watch CNN like I do all the time. We don't know what the outcome is going to be on that, but what I can tell you is that 25% of all Canadian exports originate from small businesses. So at some point, depending on the outcome of the renegotiation of NAFTA, there could be implications as well on small businesses in the country. So all of this will translate at some point into changes in behavior, changes in decisions, and potentially impacts on the economy, which leads us to July 18th, 2017, and which leads me to pass over this microphone to Gary Katz and Carol Fetter.
Thank you very much for attending, and rest assured that nobody here will be filmed other than Harold and I, primarily because we don't embarrass anyone, and really the two most filmable people in the room are Harold and I. So we'll keep the cameras firmly on us, so please don't feel embarrassed in any way or shy. We'd like to spend the next hour and 15 minutes or so cutting through the rhetoric. We'd like to, you have a copy of the slides that were provided to you. They're up on the screen as well. We'd like to sort of go through an agenda. So we're going to do a panel discussion format. We're going to be flipping back and forth. Harold and I won't be shy in rendering comments to each other. Please don't be shy to ask questions. I will tell you that these provisions affect virtually all Canadian-controlled private companies in this country. Virtually all owner-managers will be affected adversely by these provisions. And as we go through the slides, because we have the microphone, Harold and I will add our own rhetoric to it as well. So let's get started. So one of the things in your slides is, let's talk about the current system and how it's evolved and the rules that are governing planning today. And I'm going to point out in your slides, there is a typo, and I'd like you to correct it. So slide 13 and slide 30 are identical. And in the section under to an individual, where it says on eligible dividends, that should be on ineligible dividends. And on the line underneath, towards the bottom, where it says on eligible dividends, 39.3%, it should say on ineligible dividends. I apologize for that. But effectively, what the system of corporate income has evolved into is that the federal and provincial governments want corporations to be tax deferral opportunities for business income. Accordingly, the first $500,000 of small business income is taxed at a lower rate. In Ontario, it's 15%. And once your corporate business income exceeds $500,000, the corporate tax rate goes up to 26.5%. Because the system is designed to be integrated between earning the income personally and earning the income through a corporation, there has to be a tax mechanism to ensure it. So let's use an example. If I'm an unincorporated business person earning $100,000 a year, and my top corporate, and I'm subject to a top Ontario tax rate of 53.5%, I should be able to keep $46,500 after tax. And the way the integration system works is, if a dividend is paid out of corporate income on which the low rate of tax has been paid, there will be a higher personal tax on that dividend, an ineligible dividend, and that's taxed at 45%. If the corporate business income has been taxed at 26.5%, if a dividend is paid out to an individual, the top rate of tax on that eligible dividend is 39%. So if you look at the chart, if we flow $100,000 worth of income through to the individual, it basically comes out to less than a 2% difference. That is the way the system has evolved over the last 30 years, with tweaking between the federal and Ontario corporate tax rates and the federal and Ontario individual tax rates. But the federal and provincial governments do not want corporations, under the current rules, to be tax deferral opportunities for investment income. And in fact, what the system has evolved into since 1972, I might add, is corporate investment income earned in a corporation is essentially taxed at 50% up front. But there's a refundable dividend tax mechanism that I just want to walk through with you. So let's talk about a capital gain. If a capital gain is earned by an individual, we all know that 50% is taxable and 50% is tax-free. And if someone is in a 53.5% bracket, the effective tax rate on a $1,000 capital gain is about 27%. So on a $1,000 capital gain, you would keep about $733. The way a capital gain is taxed in a corporation is that half the capital gain that would be tax-free goes into what is known as a capital dividend account. It can be distributed out to the individual shareholder tax-free, and then a dividend is paid out either eligible or ineligible, again at 39% or 45%. And if you run through the numbers, you're going to come out pretty close to what the individual earning a capital gain would have come out at. The system is integrated. Similarly, with interest income, whether it's eligible dividends coming out of a corporation or ineligible dividends, you're less than 2% difference by the time you flow everything through. For dividends, your investment advisor will tell you that dividends paid between two Canadian corporations are tax-free, but in the situation involving portfolio dividends, the federal government imposes a 38% tax on every dollar of portfolio dividends earned in a corporation, but it's fully refundable when taxable dividends are paid out. So effectively, the rate of return is exactly the same once you flow it out. The critical part of this integration is that the recipients of the dividends are assumed to be in the top tax bracket. That's the integration system. And what's happened is the July 18 proposals target certain things because over the years, taxpayers and their advisors have figured out procedures where the distributions out of the corporations do not go to individuals who are in the top bracket. They go to lower income family members. And so the federal government has created an issue where they have stated that there's an inequality that exists now between high income salaried employees and owner managers of incorporated businesses. This is my first rant, but I believe the federal government has created that issue. I don't believe there was a significant issue prior, but it is something that they've raised and now they're running with it. And so the proposals are targeting specifically the ability to distribute dividends to lower taxed family members, capital gains and the capital gains exemption also to lower taxed family members, and just as importantly, the ability to hold extra funds in a corporation if they're not reinvested in the active business. These are typical structures. The owner managers in the room will understand it, of course. We have operating companies that could be owned by two spouses and their children. There could be an operating company owned by a holding company to be able to transfer cash up to the holding company, as Denise alluded to earlier, and therefore free of the potential liability of the operating company's operations, or to hold as an investment holding company and invest it. And if you were really fancy and you really wanted to have your cake and eat it too, and full flexibility with respect to planning, you would set up a family trust, and the family trust would have beneficiaries that would include family members and a holding company. So those are the typical structures that we're going to address in the next little while, and we're going to talk about the impact on these structures. I also want to point out that under the current tax rules, there has always been a reasonableness test for deductible expenses paid to family members. So the owner manager in the room might call us and say, you know, I'd like to pay my 16-year-old kid $11,000 for emptying out the home office waste paper basket. Though, because they happen to know that everybody gets $11,500 tax-free. There's been long-time reasonableness tests that would tell them that that's a very unreasonable amount to pay out, and it would be attacked by Canada Revenue Agency should it ever be audited. Same thing with a spouse who's inactive in a business. You can't simply pay a spouse any salary or casual labor amount without it running afoul of the reasonable expectation, and the asset test being, what would they pay me or my son, et cetera, for those same level of services. So we've always had a reasonableness test for deductible expenses. What the provisions are attacking is they're now making a reasonableness test for dividend payments out to family members, and they are now imposing a reasonableness test for the allocation of capital gains on the shares on the sale of private companies and on access to the capital gains exemption. So most of us in this room know that as of year 2000, dividends that were paid out to minor children who were shareholders, as of 2000, they're being taxed at the top rate. So we've been paying dividends out up to the year 2000 to all these shareholders who happen to be family members. Federal government said at the time, we don't think dividends to minor children are fair. Let's impose a kiddie tax, if you will, which essentially says we're going to call it tax on split income. Any dividend that's paid out to a minor child, it's going to be taxed at the top bracket regardless of what the minor child's other income is like. And that's been in effect since year 2000. What the new provisions propose is they're going to attack dividends to every family member, and they're also throwing in capital gains on the sale of private company shares. I'm not going to go through all the technicalities, but essentially, the current rules identify a specified individual as somebody under the age of 18. Dividends paid out to people under the age of 18, taxed at the top bracket. We don't worry about capital gains. A minor child can get his or her share of the lifetime capital gains exemption, which currently is around $835,000. The new rules to take effect as of January 1st basically say all those capital gains are affected and are going to be subject to certain rules. We're expanding it to kids under the age of 18 with respect to capital gains, and all related individuals connected to these influential individuals. They're also proposing to include aunts and uncles and nieces and nephews to this new limitation. Again, you have this in your notes. When split income is now going to include dividend income, capital gains, and again, they're going to measure it against a reasonable or unreasonable rate of return. Any capital gains in excess of what is deemed to be reasonable will be taxed at the top bracket, no capital gains exemption. Any dividend income payable above a certain reasonable amount will be taxed at the top bracket, regardless of the actual amount of the other income of the individual. So the reasonableness terms are going to be measured in terms of labor, capital contributions to the business, and amounts payable in other forms. Again, and as we'll see later on, aunts, uncles, etc., are affected, and what we're going to see in a couple of minutes is they really don't like people within the age of 18 to 24. They really have attacked that target. Those university-age kids who up until this year we've been paying out significant dividends, who have been completely useless from an income tax planning point of view for almost 18 years of their lives, are now going to become useless for the first 24 years of their lives. So let's talk about it. They're going to look at, for people 25 years of age and over, when a dividend is paid out, or before a dividend is paid out, they're going to look at what is, and we have to put a dollar value on these things. What is the dollar value of the labor component that this shareholder has rendered to the company? What is the dollar value of the capital contributions that this shareholder has made to the Canadian-controlled private company? And I will tell you that most family businesses are capitalized with nominal capital, $100, $10. So you have a nominal capital value which will limit the reasonable amount of dividends that could be paid out. Most contentiously, and I have to tell you, I'd say one of every 4 blogs in my LinkedIn connections are all about this issue, but one of the most contentious issues is how do you put a dollar value on the risk that the shareholder has taken to be part of that corporation? How do you measure a spouse who may not be active in the business? How do you put a dollar value on that? How do you put a dollar value on the sacrifices that a whole family has had to incur over X number of years until that family business has been profitable? And then if there's been any shareholder contributions, how do you put a value on a rate of return on that? For typically the university age or school age kids, the same reasonableness criteria will apply, except there will be a deemed nil value on the labor component of the 18 to 24-year-old, unless he or she, as it says in the discussion paper, unless the 18 to 24-year-old is regularly or continuously or substantially working in the business. We don't really know what that means. Does that mean substantially full-time? So again, if that 18 to 24-year-old is not working in the business, 0 value for the labor component. And as we mentioned, most family businesses, they're going to assume, again, for an 18 to 24-year-old, that the only reasonable return on capital is the Canada Revenue Agency prescribed rate attributable to the capital. Most family businesses nominal value. Let's assume that we gave an 18-year-old child $10 of capital stock. Does anyone know what the CRA prescribed rate is and has been for the last 4 or 5 years? Anyone hazard a guess? The CRA prescribed rate is 1%. So if a shareholder is showing capital contributions of $10, 1% of $10 is the reasonable dividend under these proposals, and anything above that will be a dividend if paid out to that individual that will be taxed at either 45% or 39%. Now, I'd like to also say that as we go through this, the Minister of Finance has continually said that these proposals should be tax neutral to all but the top 1% in our economy. I'd like you to understand that because we're going to talk about some examples where we respectively suggest that he's not correct. So let's go through it. But before we get to the really exciting examples, I'm going to pass this over to my colleague.
Thank you very much, Gary. Just before jumping into capital gains sprinkling, I just want to make a couple of points on some of the comments that Gary had made. First, with respect to the risk component in evaluating reasonableness. As a corporate and tax lawyer, when I have a new business client, we often talk about creditor proofing. So you end up trying to remove all the personal assets out of the business owner's hands because there's director liability, et cetera, and we move the home and other personal assets to the spouse. Then when they go to borrow money, the bank, of course, says we want the collateral of your mortgage. You want a mortgage on your home. Ask yourself, if the spouse is mortgaging the family home, is that risk? What is the proper reasonable return on that risk? I mean, so far I think the comments are pretty bland in terms of what will be acceptable, but that's something to keep in mind as you're reading the literature and hear the comments from our government about what they consider as risk. And this will be my first rant. I think they have completely underestimated, misconstrued this element and the risk that every person in the family, including the minors, have taken along the road to build successful small business in this country. The second point I wanted to make is just in terms of labor contribution. CRA took a run at this a number of years ago in terms of trying to impose a labor component to shareholdings. I mean, it's somewhat of an absurd concept. Shareholding is an ownership issue. You don't need to contribute labor to seek a return on an ownership stake, and they lost. And here they are a number of years later trying to impose it through a back door. So that's rants, I think, 2 and 3 or so far, and we'll keep it going. So switching to capital gains sprinkling, the first point I'd like to make about this issue is to contrast it with the dividend sprinkling. When we're looking at the area of dividend sprinkling, we're somewhat captive. We're in the family, we're in the small privately held business. We've got father or mother, husband or wife declaring dividends to the other spouse or to children. We're all in this captive family environment. As we'll see in my comments coming up, with capital gains issues, you may have a legitimate arm's length third-party sale, and these split income issues still come out to haunt you and deny capital gains treatment, and you end up in the higher rate tax. So the starting point in analyzing capital gains sprinkling is that any gains that you have from the disposition of property from a share, the income from which is considered split income will in itself be split income. So all of those rules that Gary talked about, specified individual, that's the person who's really running the business. Connected individual, those are people that are connected to the corporation to further cast the web of who might be caught as a specified individual. And the reasonableness test that we talked about. All of those rules are relevant to the consideration of whether a capital gain on the sale of shares will be considered a capital gain, or does it get caught within the web of split income. And if these rules apply, the ones that we were just talking about, then you've got split income, and that capital gain is now converted into an ineligible dividend. And as Gary talked about the rates, you've got from 26 3/4 into the higher rate in the mid 40s. So a very, very significant, almost 20% increase in the effective rate. So as I said earlier, the important thing to keep in mind with respect to capital gains and these rules is that they do apply on the arm's length sale of shares. So you've got the business being sold, you have a sale of shares, and you think you're home free. But if the specified individual who's selling his or her shares fails the reasonable contribution test, then you're denied capital gains treatment. And So you've got your family, you've gone out there, you've landed your home run sale on the family business, and you've got your two spouses owning shares and perhaps the kids, and only the one individual may be entitled to capital gains treatment on that disposition, and the others are going to end up with about 20% higher effective tax rate, leaving aside the lifetime capital gains exemption issues, which I'll get into in a moment. One little note here, if one of those specified individuals is already in the highest tax bracket, they'll still lose the lifetime capital gains exemption, but they will get capital gains treatment because they're already at the highest rate. So the split income will still be treated as capital gain. So let's switch now, it's a good segue to the lifetime capital gains exemption. In the proposal, what they're specifically attacking, their target is the multiplication arrangements. So family trust, or that example I just talked about, where you have multiple family members owning the common or equity shares in the business, they have pronounced that they don't like that, and they think it's unfair, even though for all the reasons we've cited, the entire family has been on this ride, taking the risk and making the sacrifices in order to achieve the success. So the proposals are designed to limit the access to the lifetime capital gains exemption to the persons who are actively involved in creating the gain. And if you think of examples, we talked about the mortgage earlier, you talked about the different sacrifices that people make, and perhaps you have a business where the value comes from an invention, a patented invention that may not even be the individual owners, it may be an employee, but the company still benefits from that. That's your sale, and even in those circumstances, it may only be that one family member who's entitled to the capital gains treatment and the lifetime capital gains exemption. And as we cited earlier, just to put the context, it's an $835,000 tax-free gain. So that's approximately $200 and some odd thousand per person. And if you lose that, that is dollars that are not ending up in the jeans of the family members. So when we look at what they've outlined, here are the capital gains exemption issues as they've proposed starting January 1st, 2018. So as I mentioned earlier, any gains included in the split income of the taxpayer, no exemption. Any gains that are accrued or realized before the year in which a taxpayer turns 18 would be denied. Any gains on property while the property was held in trust, the structure Gary mentioned earlier, where you've got a trust owning OPCO and a beneficiary co-op to the side and all the family members being beneficiaries of that trust, any gain that has accrued during the lifetime of the trust would be denied the capital gains exemption. So that is a very, very significant issue. I recently closed a sale deal, a share sale deal for a client, $25 million US. He had 8 family members taking advantage of the capital gains exemption through a family trust. 8 times 835, 6.5 million. You divide that roughly in a quarter. That's almost $2 million of tax savings, of extra dollars in his hands that would be denied in a post-2018 transaction. There are exceptions for certain special kind of trusts, joint spousal, alter ego, employee share trusts, but these aren't commonly used in these situations with family-owned businesses. The plain vanilla discretionary family trust that we've all seen is the target, and that's what's come under attack in terms of access to the exemption. I should point out that even the active owner, even the person who is involved in the business, their accrued gain while a beneficiary of the trust would be denied the lifetime capital gains exemption. So going forward, the structures that we're looking at, you have to make sure that even that individual owns their own common shares and not all the shares are in the trust. Otherwise, no one's going to get at the lifetime capital gains exemption, and you lose that $835,000. The other point I want to raise is that if you think you could be clever and you roll out shares first out of a trust and then sell them, they're onto you. And they'll deny that capital gains exemption as if it was sold from within the trust. The one concession that they have made is that they've allowed some transitional rules. Those old enough will remember a one-time trigger of the capital gains exemption on real property. They were allowed to do a bump in the cost base over 20 years ago. This is a similar type concept. So they've allowed us to do within 2018 a one-time election to crystallize any gain and get a bump in cost base, and the current lifetime capital gains exemption rules would apply. So you can crystallize, take advantage of the lifetime capital gains exemption, get a bump in the cost base of the shares, and then ultimately when those shares are sold, you'd have the higher cost base and it would reduce the after-tax hit. If the taxpayer that's trying to crystallize is under 18, then you need an actual disposition. You can't just file the election. And even though they're allowing the election and the ability to crystallize, the QSBC rules, the Qualifying Small Business Corporation Share rules, will still apply, with the caveat that the 24-month tests are reduced to 12. And very quickly, the main issue over those 24 months, besides holding the shares, is that you can't have more than half of the value of those shares being attributed to passive assets. So stated conversely, more than half the value has to be from the active business. So if you're accumulating cash and investments within your OpCo, you've got to make sure that that number doesn't hit the value of the active business assets. Otherwise, your clock resets and you need another 12 months. So sometime before the end of 2017, you better take a look at your balance sheet and analyze where the value is coming from, and make sure that in 2018 you'd be eligible to crystallize and take advantage of the capital gains exemption. A few things to watch for in these transitional rules. One is you need to own the shares continuously from the end of 2017 to the actual election date. The election date could be any time in 2018, and you have to be mindful, as I said, of that 50% issue. There will be penalties for late filed or amended elections, very steep penalties compared to other areas of the Income Tax Act where penalties are imposed. And the last point is very important, and lots of advisors are talking about this: how are we going to determine fair market value? There is a very, very significant hit if you overshoot fair market value. So you're going to have to do your homework in terms of getting proper valuations, I think, from accredited valuators, and not just kind of the ordinary way where an accountant might take a look at the balance sheet and earnings and come up with a reasonable number. I think CRA is going to be very, very, very difficult on this issue. And if you overshoot, the transferee on the fair market value is going to get a grind of their ACB back down to fair market value, but the proceeds of disposition to the transferor are going to be based on whatever you designated. So if you designate too high, your proceeds of disposition are going to be what you designated, but the person receiving is going to be back down to, the ACB is going to be back down to the lower amount. So you're going to basically get a double tax hit potentially. Back over to Gary.
Thank you. So the proposals are attacking dividend sprinkling, they're attacking capital gains sprinkling amongst family members, capital gains exemption access, and another provision that the federal government doesn't like is when a corporation doesn't need all the money to be reinvested in its business, or when the family doesn't need the money to be distributed out. So again, let me just call attention to this slide. There's a slight typo 2/3 of the way down. Under Ontario tax personal tax rate, eligible dividends should be ineligible, and eligible dividends should be ineligible. So ineligible dividends applies to the 45% rate, and eligible dividends applies to the 39% rate. So very quickly, you saw this slide earlier, the deferral opportunity on the lower income business tax, either at 15% or at 26.5% tax if the business income is over $500,000. The federal government doesn't like the deferral. The difference between the corporate tax rate and the top marginal rate to the individual if it's not distributed out. And so the provisions are aimed at discouraging the hoarding of cash within a corporation and the earning of passive investment income. Now, in all fairness to the federal government, it is a discussion paper only. There is no draft legislation, unlike the provisions for dividend sprinkling and capital gains, which are quite technical and are being reviewed right now. But the reality is that even in a narrative form, their proposals are quite complicated. We'll go through them in a few minutes. And I also want to emphasize that these provisions are only targeting Canadian-controlled private companies. Public companies can still hoard cash. They can still earn investment income, and they can still distribute their profits in the form of eligible dividends or ineligible dividends. These are only attacking Canadian-controlled private companies. It's almost like the federal government is assuming that CCPCs have been set up primarily to minimize taxes. That's really what I believe the approach they're taking. So what they're discussing are really two methods. They go back to what the federal government of the day tried to implement in 1972, or they've come up with a deferred taxation approach, really two methods and a special election. There is considerable discussion about what the government of the day in 1972 tried to bring in. There were really two refundable taxes. One, a refundable tax on the passive investment income that was earned on an ongoing basis, and one lump sum refundable tax on the extra cash that was hoarded, that lump sum. To make a long story short, that provision, the 1972 provisions, were actually repealed a year later by the then Liberal government, ostensibly because they found the provisions too complex and would hurt small business reinvestment and job creation. That's the wording back in 1973. The current discussion paper comments saying, we thought about an additional 35% refundable tax on the lump sum, but due to complexity and previous history, we decided that this isn't the way to go. It's very interesting to think that they actually included it in the discussion paper, almost like to say, you see, it could have been worse. Now here are the proposals that we'd like you to think about. And so what they're essentially thinking about is that refundable dividend tax mechanism at the corporate level would be eliminated. No reduction to the corporate tax on passive investment income, and no tax-free portion of capital gains earned in a corporation. Effectively, a 50% permanent tax on all passive income earned in corporations. And then, of course, there's a second layer of tax. There's the dividends coming out to the individual shareholders, which are either going to be eligible dividends, taxed at potentially 39%, or ineligible dividends, taxed at potentially 45%. And the real cost, so again, they're attacking the refundable tax at the corporate level and the ability to flow out tax-free capital gains through a corporation. And what the effective tax is, again, is let's go right to the guts of it, is an individual who earns a $1,000 capital gain at the top tax rate will effectively have a 27% marginal tax, 50% of 53.5%, and he or she will keep about $730 on 1,000. If the capital dividend account is eliminated, the tax on the capital gain, by the time you flow it out, will increase to 54% or 59% instead of 27%. If interest is earned in a corporation, if interest is earned by an individual at the top tax rate, roughly we keep about 47%, 1 minus 53.5%. So if I earned $1,000 of interest income, I keep $465 after tax. If interest income is now earned through a corporation, there is no refundable dividend tax mechanism. The tax, because again, a dividend will be paid out, eligible or ineligible, depending on the results of the corporation, and the tax will be in excess of 69% by the time you flow it through. So there's a significant penalty in earning passive investment income under these proposals. So the federal government is, so again, I want to harp back to what the Minister of Finance has been saying. These proposals are tax neutral. And the assumption is, if you read through some of the blogs, if you read in some of the pronouncements, what he is saying, or what the government is saying is, unless you're in the top 1%, most of us are not contributing to our RSP. We have significant amount of room left. And so you take this money out of the corporation and you make an RSP contribution, and you should be tax neutral. That's what he's saying. So again, I'm going to leave that up to you as to whether or not that is a proper assumption to make. So this is some of the very significant issues that we have is how is this tax neutral? And more importantly, what's the effect on the economy? The government, in fairness to the government, recognizes that the source of investment funds in a corporation they come from essentially three sources. They'll come from corporate income, business income taxed at the low rate, in the case of an Ontario company, 15%. They also acknowledge the fact that business income be taxed at 26.5%, and they recognize that shareholders can put money into the corporation, again, which may generate some investment income. So to create more equity in their eyes, they're proposing two methods, an apportionment method and an elective method. I'm not going to go through the details, you have them in your notes, but effectively there's going to be two pools. There's going to be one pool of retained earnings that has been taxed at the high rate of tax, 26.5%, and any dividends coming out of that high rate of tax will be considered eligible dividends for the low rate of personal income tax on those dividends. And then there's going to be another pool. Any income that's been taxed at the low rate of tax will generate ineligible dividends, taxed at the high rate on dividends. And then there's going to be an investment pool that's attributable to the extra cash the shareholder may have put in. That is actually going to be able to be distributed out tax-free. So any investment income pooled through capital contributions can be paid out via a tax-free dividend. The only issue is most family businesses are capitalized with nominal amounts. So that pool will be extremely small. And again, I want to emphasize that public companies don't have this complexity. Public companies can hoard cash, they'll earn investment income, they'll distribute out the investment income in the form of dividends, eligible or ineligible, and again, we'll get the advantages of that. The second method that the government is proposing, all in narrative form, is an elective method. It avoids the tracking, it avoids the pooling concept, and it basically says all CCPCs, all Canadian controlled private companies, will be assumed to be getting the small business rate of tax, and therefore any dividends coming out, ineligible, and therefore taxed at the higher rates. If the company elects out of that default, they will lose the small business deduction. They will not be able to be taxed at 15%. They'll get taxed at 26.5%, but any dividends coming out will attract a lower personal income tax rate. And again, they're not looking at the nature of the income. It'll be either taxed as, and they're not worrying about the shareholder contribution under the elective method. There won't be any the ability to pay out any tax-free dividends especially if there's no significant capital contributions anyway. So those are the two methods. They do acknowledge that there are many companies that earn only investment income, and they're contemplating a special election for investment holding companies where the refundable dividend tax mechanism will be maintained. The only difference is where, as I mentioned earlier, if dividends are paid out between two Canadian corporations, there's typically no tax on that. They're proposing to charge a refundable tax between those two payments temporarily, pulling it out of the system. When a dividend goes out to the individual shareholders, the federal government will give back the money in investment holding company scenarios. There are no details. It's purely narratives. We have no idea how this is going to evolve. So let's get to the guts of this, and I'd like to talk about a couple of things as we go through the examples. One, how is this example connected to the top 1% of the people in our economy? And how is this tax neutral? So let's talk about a daughter and a mother starting up a clothing boutique. The mom owns 50% of the shares. The daughter owns 50% of the shares. The daughter works in the business. The mom is silent. She's not involved in the business. let's add a little bit. Let's say the mom contributed $100,000 to get the business going, but is otherwise passive in the business. First year, there's a loss. Second year, there's income of $50,000. Neither shareholder has taken out any money throughout the 2-year process. Mom wants $25,000 out, and she has $50,000 of other income. So let me harp on this. Is there any numbers in here that attributes any of these two people to the top 1% in the economy? So under the current rules, if we gave mom a $25,000 ineligible dividend, income on which is taxed at the low rate, the marginal tax rate on dividends is about 17% as a resident of Ontario. So she would pay 17% additional tax on $25,000. If the $25,000 dividend is deemed to be unreasonable, there will be an automatic 45% tax on it. So how do we come up with a calculation of what's reasonable or not reasonable, given that mom doesn't work in the business? She's contributed $100,000 to start the business. How do we come up with a number? And so, you know, if she and her advisor says, we think, let's say that we think $25,000 is reasonable. We file a tax return, we pay tax at 17%. Canada Revenue Agency comes in. And Canada Revenue Agency says 2 years later, you know what? We don't think $25,000 is reasonable. We think $10,000 is reasonable. So they're going to do a calculation. The $10,000 would be taxed at roughly 17%, but the $15,000 would be taxed at 45%. And so the difference between what she's paid already at 17% and 45% is the additional tax under assessment. And so she's going to come to Gary Katz at Logan Katz, and she's going to say, I'm outraged by it. I'd like to fight it. And because my partners have drummed this into me ad infinitum, I'm going to say, great, we need a check from you for about $5,000 to help you fight it. And by the way, really sorry, but we have no idea if we're going to win this or not. What do you think mom's going to do? Mom is going to reluctantly write a check to the CRA, not to Logan Katz, right? And she's going to go off grumbling. And that's one of the biggest fears in all this, is the practical side to having a CRA auditor judge and the team supervisor judge what is reasonable. There are no safe harbor rules published, there are no published guidelines, and there are no court cases on this. What is reasonable? Again, tax neutral, and what's the effect on the economy? Second example, 2 spouses own 40% of the business, family trust 20%, kids are the beneficiaries. After 5 years of operation, company earns $100,000, and spouse 1 takes a salary out of $75,000 from the business, leaving $100,000 of profit in the business. So 15% tax, there's a distribution of $85,000 available. And under the current rules, as many of you know, if spouse 2 has no income and the kids are over the age of 17 and maybe in university have no income, you know and I know that we can distribute that $85,000 with virtually no tax. That anybody can receive in Ontario about $35,000 to $37,000 in dividends. And if it wasn't for the Ontario government a few years ago imposing a surtax of maybe $450 to $700, there would be no tax at all. But the Ontario government said, we'd like something, so we're imposing a surtax, and it could range in the range of about $450 to $700 per person, but virtually no tax. Under the proposed rules, if spouse 2 and the kids are not active in the business in any way, then the money coming out would be probably taxed in the hands of S1. And if the dividend went out to her, the active spouse, there would be about a 30% tax on that $85,000. Is that tax neutral? Do any of these numbers affect the top 1% in the economy? And so regarding other family members, again, not to harp on it too much, but how do we determine a rate of return with respect to contribution to the business? So spouse 1 comes home, and tells her significant other of all the problems during the day that she's going through, and even if he doesn't want to listen to it. And spouse 2 will give her advice whether she wants to hear it or not. How do we put a dollar value on that in terms of reasonableness? How do we put a dollar value on labor or contributed assets if there aren't really any? How do we even put a dollar value on the deferred rewards or assumed risk? That's what is causing people a lot of concern with these proposals. Now, again, I just read in LinkedIn this morning that the Ministry of Finance will be doing public sessions through the local chambers of commerce. They're scheduling up to 25 national presentations, or across the nation, I'm sorry, between now and the end of November. You're probably going to hear more about it. The problem we have, of course, is we're in limbo. So if we were hoping to get some decisions and some extensions by October. They had originally said October 2nd being the deadline. The problem right now is it looks like they've extended out to November. In the meantime, as Harold will mention later on, we have planning, we have corporations to set up, we have dividends in 2017. That could be the last time we take advantage of it. We have people dying. They're not stopping. And we have significant issues involving that as well. We've left in the slides, actually this is taken right from the discussion paper, the federal government's examples of the apportionment method. I'm not going to go through the details, but it does pool between the low rate of corporate tax, high rate of corporate tax for business, and shareholder contributions, and then looks at eligible and ineligible dividends. And if you go back to our example, you'll see the tax rates will range anywhere from in excess of 50% to in excess of 70%. They also give examples of the elective method. Again, you have it in your slides and all publicly available. On that note, let's talk about capital gains.
Thanks again, Gary. So we're going to switch gears to something called surplus stripping. And this area, while very, very important, as we'll soon see, is probably getting a little bit less press than the capital gains and income sprinkling issues and the passive investment targeting. So what do we mean by surplus stripping? It's the conversion of dividends into capital gains, which, as we've talked about throughout the presentation, are taxed at lower rates. So there's mechanisms to basically take corporate surplus that would otherwise come out as dividends and convert them into capital gains. So one area where we see this commonly is on a transfer of the business between family members, where we incorporate a new company to be the purchaser, and we use after corporate tax dollars and out of the future profits to pay for the acquisition of the shares. So that's a common usage to get around dividends coming out and having value being contributed through corporate profits being distributed tax-free between non-arm's length corporations. So we've already got existing Section 84.1, which somewhat deals with that scenario. But under these proposals, they're presenting a tweak to 84.1, and I'll talk about what the significance of that is. And they're also proposing a new anti-avoidance rule, because I know all of us go to sleep at night thinking, you know what's missing in the world? Another anti-avoidance rule in the Income Tax Act. So that's what we're going to get in 246.1. So currently, 84.1 applies to, as I said, non-arm's length sale of shares of a corporation to another corporation. And it's that family succession scenario where we often run into this. The result is that 84.1 will deny the lifetime capital gains exemption to the seller, but it will allow capital gains treatment. So you're still at that lower rate compared to dividend income. Under the new rules, this planning technique will be eliminated. So the result will be to the transferor an ineligible dividend. So the tax rate effectively to the transferor selling his or her business through this method will go from 26.75% to 45.3%. And interestingly, if we compare that to an arm's length sale, so let's assume we've got a $6 million share price and the one individual is claiming the capital gains exemption, the effective tax rate is 23%. We compare that to 45.3, give or take, you're talking about half. So there's a clear prejudice to try and keep family business within the family, which again, how do you talk about that being tax neutral when there's an incentive to sell outside of the family? The other area which is significant, which has to be noted, is the element of retroactivity in this new provision. And even though the government and Morneau in his articles and responses is talking about we're not looking backwards, well, the fact is this so-called soft ACB, so this non-arm's length ACB, can be pre-July 18th, 2017 transactions. So things may have gone, and there's even commentary that you may not even have the records anymore of what went on because it's so long ago that they can trace through the soft ACB and still hit you with this new 84.1 rule and deny the capital gains treatment. So as I mentioned, this clearly prejudices trying to keep corporate assets within a non-arm's length group. What the policy reasons for that are, I have no idea, and we'll leave it maybe to the government on their town hall meetings and dog and pony show across the country to try and explain it. The proposal does invite comments because they've said we don't want to catch genuine intergenerational transfers, but the legislation they put out doesn't contemplate that. There's no carve out, so it remains to be seen how they're going to define that and how they're going to make distinctions in the legislation. So let's turn now to 246.1, and although Gary and I agreed that we wouldn't get into the weeds of the actual legislation, I read this and I could not resist putting it up there for you just to highlight kind of the absurdity of the language. So this new anti-avoidance rule, if all the other rules don't catch you, and if the general anti-avoidance rule doesn't catch you, they want to try and apply this. Reasonable to consider that one of the purposes of a transaction, event, or series was to effect a significant reduction or disappearance of assets. Who knows what that means and how one would accomplish a disappearance. Including assets acquired or held directly or indirectly, again, broaden the ambiguity, at any time such that any part of tax otherwise payable by the individual with respect to the portion and in consequence of any distribution of property of a corporation is avoided. Now, everyone understand that? And Gary talked about the practical implications of these rules and how do you actually make decisions and what's going to happen if those decisions are challenged. And CRA has admitted to this, and finance has admitted to this, that this is an actual strategy in the legislation. Create ambiguity and uncertainty that make people fearful of taking reasonable planning steps. And Denny talked about Section 55.2, which came out in a recent budget, the changes to that. They've admitted to this, that it's deliberately vague and ambiguous and catches seemingly innocuous transactions because they know that people will be afraid of taking legitimate steps. And they thrive on that uncertainty, unfortunately, to the detriment of small business owners like yourselves and if you're advisors, like your clients. So the implications of this rule, if you're caught by that web of language in this new anti-avoidance rule, is that capital gain would be recharacterized as a taxable dividend, and you lose CDA. Gary talked about CDA, the capital dividend account. That is the mechanism by which we get integration on capital gains, because the non-taxable portion of a capital gain that a corporation realizes gets to be distributed tax-free. If you lose that, then you've lost the integration. You're effectively double taxed because you're getting taxed personally on gains that have already been taxed in the corporation. Again, like with the tweaked 84.1, there is retroactivity because in that mangled definition that I read earlier, there's reference to a series, and the series can start before July 2017. So people could have undertaken transactions under the old rules that are now caught back because of the series concept in the new rules. Let me talk a little bit about how this impacts intergenerational transfers, particularly on death. So where someone passes away owning shares of a corporation, there's an element of double tax. There's a deemed disposition on those shares, and the underlying assets of the corporation have inherent tax in them as well. I won't go into the technical details, but there's a strategy called the pipeline strategy, which is intended to eliminate double tax. So basically it gets rid of the dividend coming out of the corporation, and it leaves you just with the capital gain on the deemed disposition. And effectively this amendment to 84.1, this very subtle amendment, has basically killed the pipeline strategy. So that now would be off the table if these rules go ahead unamended. There's another strategy that can be used to deal with the tax implications on death holding corporate shares, and that's 164.6. Again, I'll skip the technical details, but it's a loss carryback to try and eliminate the capital gain, so you're just left with the dividend. I'll just go through in a moment the effective tax rate implications. The significant thing to point out about 164.6 is you need the graduated rate estate characterization in order to be able to access that. And those were rules that were implemented in January 2016 dealing with estates. Very complicated, very easy to lose inadvertently the GRE status of an estate. And if you lose that, then you lose 164.6 as well. So pipeline dead because of the 84.1 changes, and 164.6 very challenging because of the GRE rules. So let's take a look at an example. We got a $5 million value in a holdco. Using the pipeline, the numbers to the right are your after-tax dollars. So under the pipeline strategy, you're left with 3.74 million. Under 164.6, if you've been able to maintain your GRE status, you're left with 2.9 million. Under new 84.1, you're left with 1.64 million. You started with 5, you're left with 1.64. Again, it's less than half of the pipeline strategy in terms of after-tax wealth. And again, you may have read or heard Morneau speak about how whatever you've got to date, we're not touching. Person dies holding these shares, you've cut their after-tax dollars left in the estate out of that holding company in less than half. And go ask yourself, how is that not affecting wealth accumulated to date? With all that doom and gloom then, so what do we do next? Really tough to know. We've been saying wait and see, that after October 2nd, we'll have lots of time to start thinking about planning and strategies. But now that date may be pushed into November, and we're going to have a really shortened window in order to accomplish anything in 2017. So one thing to be thinking about is that purification in 2017 and the election, the crystallization election in 2018. So in 2017, as a reminder, you've got to be wary of that 50-50 rule. You have to make sure that your assets, your non-business assets in your corporations are below 50% of the total value. Otherwise, if you start 2018 with that offside, you're going to lose that opportunity to crystallize in 2018. One strategy that people have talked about, Gary commented on this potentially, is do large dividends to people who would otherwise be specified individuals post-2018. Do that before the end of 2017. You can use promissory notes with dividends. You can declare a dividend payable by a promissory note. So if cash is short, you can still do it by promissory note and pay it out over time to satisfy the note. The note has to be actually a demand note, but that could be a strategy to get extra income out to low-income taxpayers before the calendar page turns over to January 1st. Another possible strategy, assuming all of these go through, we have disincentives to distribute income and in cash is being kept, is to use an IPP for the principal owner. That's an individual pension plan. Each individual situation would have to be looked at as to the merits, but that is a possible way to get some additional deductions within the corporation for the principal shareholder. The last point I want to make, and I think the most important thing to take away from this, is we have a short period of time. There's 175 or so people in this room. You 175 people probably know between you thousands of people that are affected by these proposals. Speak up. Every single voice counts. Talk to your MPs. Bombard with letters, phone calls. Speak to your industry groups. You know, people have this image, because that's what's being said, is it's the top 1% that are being attacked, and it's loopholes that are being closed. Both of those, as we've shown today, I think are false. Speak to industry groups. If you've got clients in trade groups, they're the people I think that could be the face of the backlash and the response, not necessarily doctors and lawyers and accountants and financial advisors. It's those people in trades that have put in the blood and sweat and sacrifice and mortgaged homes and to make things work and work the 80-hour weeks to make their business work. Those could be the voice of protest. Your competitors, your suppliers, your people, downstream purchasers. All of these people can be voices, and we're starting to hear, I think, from the news on the caucus meetings that MPs are getting nervous. We need to make them really nervous that the next election coming up, this is going to be a serious election issue, and their run will end. So don't be shy, and recognize that every single voice in here and out there will make a difference.
Thank you. We're in very, very uncertain times right now, and probably will be for another couple of months. For the lawyers in the room and the advisors, what do we tell our clients in terms of incorporating company? Who are going to be the shareholders in the company? Family trust could be effectively dead or not. Inactive family members could be completely useless from income splitting and capital gains point of view. So how do we tell these people who are incorporating companies how they should hold the shares? If somebody passes away, the pipeline strategy was effectively killed if the proposals go through July the 18th. They're not in effect for January 1. So, what do we tell an estate to the executors and the beneficiaries in terms of strategy as to whether or not the pipeline strategy would even work? It's very, very serious for those people who are in those situations. And if, again, the delay in decisions is sometime in December or later on, early next year, it's going to be very difficult to plan. Well, thank you very much for coming. We appreciate it. Hope you found it informative. We will stick around after and answer any specific questions. And let's get back to work.